Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review. Confession, I kind of made a clickbaity thumbnail title, which is like First Lien HELOC bad. 30% credit card, good, right? Kind of like you're a 5-year-old. But I just kind of did that because I know some of you are fascinated by this topic. Last time I made a video about how your 30% credit card will be a First Lien HELOC, and this is kind of one of the most highly viewed, highly watched videos recently in this channel. And so I just kind of thought I'd do it again. And to be honest, when I learned this, I was kind of shocked because if you don't know how the real estate market works, people just solely focus on the interest rate. So to figure out that an 8% first lien HELOC replacement will not be a 30% credit cards, like that doesn't even make sense, right? And so we're just going to do another review again of velocity banking. So, what's velocity banking? All it is a debt payoff strategy where you use your line of credit as your main operating account. In other words, you throw all your money at debt with the help of a line of credit. Now, there are some peeps on the internet who say this: listen, you got this 3% mortgage right here, like this $350,000 3% mortgage. And actually, did I put the right number? Give me 1 second. No, I did not. So let me just redo this. My bad. All right. So let me just do this right here. Okay. So you got this $350,000 3% mortgage. Mortgage bad because amortized loans are bad. And amortized loans are amortized interest, and lines of credit is simple interest. Therefore, lines of credit is good. And that's actually not true because loans and lines of credit calculate the interest the same way. Line of credit, specifically the average daily balance, and the loan is based on the statement balance, which is for 95% or 98% of cases the same as the average daily balance. Okay. Now, here's the thing, right? So they're saying, hey, if you got all this debt, okay, just put it in the line of credit. You use what they call a first lien HELOC replacement. And I'm telling you, as a person who owns a first lien HELOC, right? I'm a first lien HELOC owner because I paid off my mortgage in 2 years and 9 months. And because of that, ChatGPT calls me the GOAT, right? The greatest of all time. So I got the Meta AI coming up with pictures of how I'm the GOAT. Okay, but this is a mortgage paid off in 2 years and 9 months. I have a first lien HELOC, but I did it strategically, right? Just as one of our former presidents used to say, hey, you got to do it with strategery. I did it with strategery. And one of the most important things about velocity banking is the debt payoff order. Okay, the debt payoff order. And so if we just say, hey, look at all this debt, it's 30%, and we'll put on an 8% home equity line of credit, and the mortgage is at 3%, but that, amortized loan bad. So, it doesn't even matter what the interest rate is. So let's just replace it. Um, that's kind of, we don't want to get into super simplified thinking like that, right? We want to understand, hey, if I pay off my debt quickly, and I might, if I use that 8% line of credit, I might pay a little bit more. Was the trade-off worth it? Even though in total I paid less, right? Things like that. Everything is a trade-off. It's kind of like, if I told you that you could get the cheapest membership for the gym at the New Year's, should you buy it? I would say probably not, because that's money thrown out the door, right? Maybe you might think about paying a little bit more, or maybe on the in the non-New Year season, and then you'll actually get the value out of going to the gym. And that's how I kind of want you to think when it comes to debt payoff as well. Sometimes we might have to pay a little bit more with the line of credit. I did demonstrations of this previously, and I'll do it again with what happens if you use a 0% mortgage and pay it off with a 8% line of credit. And so that's what we're going to do today. All right, so let's go ahead and get started. And so this is what we're going to do. We're going to do a first lien HELOC replacement and compare the results of a second lien HELOC, right? And so if you don't know what these terms mean, so think of this as like you have a home, and because your home has value, the bank's willing to lend you a credit card based on it. That's like a very simplified explanation. And they say, hey, we'll kind of do like a balance transfer of all your debt into that HELOC, home equity line of credit. So kind of like that, it's like a balance transfer based on that credit card that is tied to the value of your home, right? And so second lien HELOC means like, hey, we're not going to do any balance transfer. We're just going to give you the credit card based on the value of your home, and it's probably going to be a smaller limit. Okay. So first of all, let's actually do this. I want to sum up all the debt that we have. So this is 27, 35, whoopsie, 35, 18, 5, 8, 15, 27, 37, 10, 20, 25, 12, 100, 350. Okay, how much debt is that? That is $689,000 of debt. $689,000. So this is what we can do. We'll just say 690, and then we'll do a let's say a balance transfer of all the debt, 689,000. And so basically what a first lien HELOC would do is essentially get rid of all the payments of the debt. Okay, all the payments. So all of this would go to zero because it's like doing a balance transfer. Okay, so let me just kind of show you here, and I'm going to copy this. And so what this is basically, because we don't have any payments, now our cash flow, our supposed cash flow, is $9,000, and that looks pretty good, right? $9,000. All right. Okay. Well, let's just go ahead and do this. And remember, it's 9,000, but we haven't factored in the cost of the interest of the line of credit. And so the final step is you put your entire paycheck into the line of credit, take your expenses out, and then rinse and repeat over and over again. Okay. So we're going to go ahead and do that. I'm going to do that right here. Whoopsie. So we'll get the next month's, which is the previous month's balance plus the previous month's interest minus our cash flow, which is 9,000. Okay. And then we have to calculate the interest in the line of credit. And so this is a lower interest rate than most of the debt, but it's higher than the mortgage. Okay. So this is 0.08 divided by 12. And ooh, look at that. So again, if you're in a desperate situation where it's like you got negative 600 and you did this, it's not the end of the world, right? Like it's not literally not the end of the world, okay? Because at least you're positive now, even though you're paying like 4 grand of interest a month. So, but let's just kind of, because we want to be able to optimize our debt payoff. So let's just see if this is like the optimal strategy for doing that, of replacing all of our debt at 8% and then doing this velocity banking strategy, which is dumping all your entire paycheck into it and then expenses out. And then we see that in 107 months, okay, 107 months, this is all paid off. So I'm going to go ahead and do this. We're going to sum it up. And then this is going to be 272,000 of interest, and then 108K divided by 12. So this is going to be about 9 years. Okay. Well, I'll just put 108 months for now, just to be exact. Okay. So let me go ahead and copy and paste this. So again, at least we're positive now. So it's not a bad thing, because if we're, stuck in this situation of negative $600, that could have been, I wouldn't say the end of the world, but it could feel like the end of the world if you're at negative money and you got all this money coming in, right? So let's go ahead and now do the second lien HELOC. So what's the second lien HELOC? Basically, it's just kind of not doing the debt transfer. That's all it is, right? And so let me go ahead and recopy all of this, okay? So I'm going to recopy all of this. And this is what we're going to do. We're going to pay off the debt in strategic order. So credit cards first, then usually the student loan, or I'm sorry, then usually the auto loan, then the student loan, and then the mortgage, okay? So we're going to go ahead and sum up how much credit card debt that we have, which is 27, 35, 18, 5, 8, 15, 27, 37, 10. And then I'm going to sum this up. So it's 182,000 in credit card in total. So this is what I'm going to do. I'm just saying we're going to have a $200,000 limit, second lien HELOC, and this is going to be 182,000. All right. And so again, we're going to transfer debts and pieces at a time, starting with the credit cards. And so because we only did 182,000, these 10 credit cards go away. All right. So now let's go ahead and do this. So 0, 0, 0, 0, 0, 0, 0, 0, 0. And then now our cash flow is $5,329.61. And so let's go ahead and do this. 5329.61. Okay. And we see that it's so much better, right? So much easier to deal with. Okay. So let's go ahead and see when we stop paying the debt, which is in 39 months. So I'm going to do right here, 39 months. And so how much, this is going to be 0. And how much debt is this? Or interest, I'm sorry. It's going to be 24.3 grand, 24.3K of interest in 39 months. All right. So let me go ahead and copy and paste this. Right. And so, and this is just for the credit cards, and then we're going to do it in strategically pieces at a time, right? And then, so in 39 months, we got to figure out what the balances of all the other loans are. So luckily we have a loan calculator for that. And all I got to do is type in 39, 39, 39, 39, 39. And the easiest way I like to pay off the debt is by using what we call the cash flow index. So just a short summary, the lower the number, that's the ones you want to pay off. Think of it as a debt ranking payoff system. So what does a lower number mean? Basically, if I pay this off, I get a lot more cash flow than paying this off. So you see this high number. If in order for me to pay off the mortgage, which is $350,000, or if I pay off the mortgage, I only get this itty bitty $1,400 for paying off $325,000 of debt. But if I, let's say do these three, and how much is these three? Let's just do this. 21 grand. Okay. If I do 21 grand, how much cash flow do I get? Let's do this. I get $1,000 of cash flow. So what's better? Pay off 21 grand to get $1,000 of cash flow, or pay off 325 grand to get 1,400 in cash flow? See how that works? So what we're going to do is get this 21 grand and move it into the line of credit. Okay. So I'm going to do this right here, and I'm going to copy and paste, and let's just do this one more time. And okay. So now, plus 21694.95. All right. And then I'm going to copy and paste. And then now what's our new cash flow? Okay. So our new cash flow is based on all these three auto loans being paid off, 0, 0, 0. Okay. And then now our cash flow is $6,414. Amazing. All right. So I'm going to copy and paste. And then now what we're going to do is just do this. And hold on. Did I do this wrong? I think I did. My bad. All right. So let me copy this. And then I'm going to add this right here. Probably screwed up. Yeah, I screwed up. So let me just try it one more time. Okay. This is plus 21694.95. And then now let's put in our new cash flow, I think. Yeah. All right. So now, all right. So now our cash flow is 6414.18. Okay. And then let's see how long it takes for us to pay it off. 43 months. Well, blam. And then, so now this is going to be 0. And then, so I'm going to do this and we'll just say the interest accrued here will be added. Oh, whoopsie. So let me just do this. My bad. So equals sum H39 to H43. No, 43. 3, I believe. Let me just see. Did I screw up? Yeah, I did. H4. Oh, whoopsie. I realized that I've done something wrong. H41 to H45. There we go. All right. So now we paid about $300 of interest at 43 months. $300 of interest. So let me just do that. $300 of interest in 43 months. Okay. And then this is going to be not the credit card, but the what is it? It's the auto loans, okay? Wow, that was really quick. No, no, no. Actually, I screwed up too. So it's actually I have to do this. I forgot. Okay, my bad. All right. So this is what we're gonna do here. Is that what we're gonna do is just add. So since we paid these, okay, 300. Okay. We're just gonna add all these up. So this plus this plus this. All right. Plus 300. Because we're accounting for the interest that we've been paying until as we've been paying off our debt. So it's going to be 7.3 grand. All right, so that's good. So I was like 300 interest in auto loans. That's amazing. I was like, so that seems wrong. 7.3 grand. All right. So now let's go and to the student loan, which is 100K now, or I'm sorry, it started off at 100K and we're at 43 months. So let's just do this 43 months. And this is going to be 000. And then now what we do is just type in 43 here, 43 here. Now, here's the safest bet when it comes to paying off amortized loans with the lower interest rate. And 98% of the time, you're going to deal with, when you're dealing with amortized loans, they're gonna usually have lower interest rates in lines of credit. And why is that? It's because the interest rate represents two things. Number one, how much risk you are to the lender. So the higher risk you are, the more the interest rate goes up. But also number two, okay, number two, what it represents is the amount of access you have to your money. And because the loan is a one-way street, the interest rate will be lower, right? It's just I don't want to say obvious, but it's just how it is, okay? And so if you're dealing with amortized loans where the interest rate is lower, and for a foreseeable amount of time, and you don't get that much cash flow, safest way to pay it off is what we call a chunking method, which is means split the loan into pieces. Like take a chunk that's kind of similar to your paycheck, like 12 grand, and then pay it off, rinse and repeat over and over again. So just kind of quick demo. What I mean by that is, let's say we want to overpay the loan, just move like 12 grand into the line of credit. Okay. So what we're going to do is just do this right here. And actually, let me just copy this. And what we're going to do is move 12 grand plus 12000 into the line of credit. And then we see that in 2 months, we paid off that 12 grand. And then we just rinse and repeat over and over again, right? Easy. All right, so let's go ahead and do this with the amortized loans. And luckily, we have a Velocity Banking calculator for this. So even if we're using an 8% line of credit, the effect of that 8% line of credit is very minimal when dealing with a lower percentage rate, especially if the interest rate is similar. Like if you have a bigger interest rate spread, and which I'll show you with the 0%, there's more of an effect. Okay, I'm gonna just throw it out there. All right, so what we do here, we just type in the details, and this is gonna be $100,000 loan, so 10000. Current balance is 7808.05, 7808.05, and let me kind of zoom in a little bit. All right, what's the interest rate? Interest rate is 6% 10 years, and then this is going to be 1110.21. 1110.21. Okay. And so now let me go back here. What's the paycheck? 12 grand. Oh, let's just do 12 grand of income. And then we'll just say that we're just doing a 12 grand chunking amount. And then living expenses is everything except for the loan we're trying to pay off. So it's just these two. Oopsie. All right. So these two, I'm going to sum it up, and it's going to be 4475.61. So 4475.6. All right, so 0.9 years and 1.9 grand of interest. And we'll just kind of, for make it easy, say 2 grand. I don't know, just, yeah, 2K. So this is what we're going to do, 0.9 years. Okay, so which is 0.9. So it's 43 plus 0.9 times 12. So it's 54 months. And this is the student loan. Right? Student loan, and let me go back here, which is we'll say 2K of interest. So what we got to do is we got to just add $2,000, and what's the total amount we pay? It's about 20.5 grand. Okay, 20.5 grand of interest. So we're going to do this 54 months, 20.5K of interest. Okay, so credit card, auto loan, student loan, and then what's the last one here? It's the mortgage. Okay, the mortgage. And so now same thing, 54 months, right? 54 months. Now here's the thing I want to show you is that what if our loan was at a 0% interest rate? Okay, so if this is like 0%, our payment would be $972.22. So I'm just going to fill this in, $350,000 at a 0% interest rate at 30 years. Okay, so 972.22 is our mortgage, and technically at this point, right, like this would technically be our last debt that we pay off. And let me just kind of readjust this here. So it'd be $3,000 of expenses. So if I readjust this, okay, even if we're doing an 8% let's say line of credit, the most we would pay on this loan, overpay, is 0%. Like, all right, let me rephrase this. So let's say that you were a giant idiot and you had a 0% mortgage, and you decided, hey, I'm going to chunk my 0% mortgage because amortized loan's bad and it has amortized interest with the 8% line of credit. Well, if you did do that, and I'm not saying that you should, and I probably wouldn't do this either with a 0% mortgage, the most you could overpay is 2 grand. However, if you use a $350,000 line of credit and do a first lien replacement, you're going to pay 57 grand. So again, yes, the 30% credit card, and let me just kind of show you here. So 12,000 at 30%, you see 8 grand will beat 59 grand, right? Or 57 grand. So it's not intuitive about how this all works, right? And so again, if I'm going to do this, I just probably start using credit cards. Um, if I really want to, and first of all, I wouldn't really even use credit cards. But if I did, I would overuse that rather than a first lien HELOC because I know that I'll just save more money, right? I don't need to replace all of my loans with the line of credit. That's a big mistake. I could just do like, small chunks, $12,000 at 30%, and it will still beat a first lien HELOC, right? And obviously, the lower the interest rate, the better. But it's not obvious that a $350,000 8% HELOC will actually lose to a 30% credit card with chunking, right? So 57 grand in interest. You see that right there? So we're not dealing with the 0% loan, but I just want to demonstrate that yes, there is a cost to using the line of credit as a tool, right? And this is kind of like the worst case scenario. And so the bigger the interest rate spread, the worse that you'll kind of do in terms of overpaying. But the thing is that even if you did 0% and you did chunking, okay, you overpay by 2 grand and you pay it off in 3.3 years, right? So let's just go ahead and do this. And now, okay, let me go back here and I'm going to take this one off. Delete row 7. So now what is it? It's a 3% interest rate at 30 years. And what's the payment amount? 1475.61. 1475.61. All right, so we see that it pays off in 3.5 years, and we would have originally paid 181 grand, and now we're paying 20 grand. All right, so now let's go ahead and do that and pay the 20 grand. Okay, so 20, what is that? 2200. So now we paid 65.2K in interest. Okay, so this is how we do this, and 65.2K or 2K of interest in how many months, and then this is going to be 3.5 years is 3.5 divided by 12 plus, no. Okay, so that'll be about, wait a minute, did I do this wrong? 3.5 times 12, my bad. All right, 96 months. Ooh. All right, so 96 months it takes for us to pay it all off. That's good. And so now, yeah, let's just do a comparison. Okay, so we'll just do this. Total interest, which is 272K, all right? And then total time, okay? And in the first lien HELOC, which is 108 divided by 12, which is 9 years, okay? Now let's just kind of do the same thing here, right? So how much interest do we end up paying, which is 24.3 plus 7.3 plus 20.5 plus 65.2. That's going to be 117.3K of interest. So what looks better to you, 272 or 117? That's like more than half, right? And then now let's just calculate the time, which is 96 divided by 12, right? Because we kind of it's not the amount of time it actually took, it's just the milestone. All right, 8 years. All right, so what's the difference? Okay, it's 272 minus 107.3, so it's 154.7K of interest. Oh my goodness, that's like 5 Teslas, folks, I think, or 3, I don't even know. Y'all want to buy me a Tesla? I bought a new Toyota Corolla this year, so that could buy me maybe like 5 Toyota Corollas. Yeah, 5, I think, if I'm not mistaken. And then here we have the 1-year difference, right? So again, can someone tell me why the first lien HELOC is so good? Because doesn't seem to win at all. It's like double the interest or more than double, right? Because double is 117 more, but we're paying $154,000 more. And people on the internet promote this. It's interesting. It's interesting. So, well, that's it for today. This is Korean Atlanta Mentorship. It's a beautiful holiday. It's a beautiful Monday. And I'm gonna say the standard YouTube stuff at the end of the video. If you like this video, like, comment, and subscribe. All right. Well, have a great day, everybody, and I'll see you on the next video.